we often beat our competition by 30 to, I think our record in the past 2 months is $60,000 below our competitors' offers by discussing this with the seller. And so you're not dealing with an uneducated seller. You're dealing with a seller that isn't served by a higher offer because they're not actually solving the fundamental problem. Whereas
Um,
most people, 80% minus repairs, we're like, well, let's see what the seller actually wants and let's hit it from the other direction instead.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
TJ Kosen has been investing in real estate since 2006, first cutting his teeth before the crash with a 200-unit plus multifamily property in Tennessee. He has done deals in Texas, California, Tennessee. TJ, welcome to the show.
Hey, thanks for having me on, Sam. I'm excited to share some insight.
Absolutely. The pleasure is mine. There are 3 questions TJ asks every guest who comes on the show in 90 seconds or less. And you tell me, where did you start? Where are you now? And how did you get there?
90 seconds or less. I don't know about that. I'm from San Diego. My first deal was 112 units in your hometown, Memphis, Tennessee. It was a lot of fun. 2006. Let's see where I started, where I went to, and where I am now in Dallas, Texas. We move a high volume of distressed, mostly single family, direct to seller residential properties in our North Texas market, also in Houston, some in Tennessee, and some in Florida right now. We're doing some marketing down there. We have a pretty good sized team, and we really specialize on the direct to seller marketing, and we specialize in the optimizing our exit strategy based on the fundamentals of both sellers' requirements and the deal specifically.
Okay, I'm excited here to dig in today. I know this show, of course, is a commercial real estate show, but I think anytime you can take a business like what you're doing, you've figured out how to scale it. I would say that what you're doing is probably more complex than buying a 200-unit multifamily, say a B-class multifamily property in Dallas. I would think would have fewer moving parts than what it is that you're doing. Would you agree with that or not?
Oh yeah, one of my biggest hurdles really from transitioning from multifamily and the crash back in the day to more single family was how much more specialized and individualized the product had to be, at least on a 1-to-1 basis. So the way that I kind of overcame that fundamental issue with the business model is treating the single family business more like a commercial kind of operation, where now we're hiring specialized people to do specialized tasks, same as you do in multifamily. You're going to hire a manager to do a specific thing. You're going to hire a maintenance guy to do a specific thing or whatever it is. So we did basically the same type of model, same type of mindset with residential distress stuff, even down to rehab. So I said we optimize our exit strategy based on the property. But if we're doing, for example, a renovation, we try to keep the renovation very simplistic in terms of we're doing the same thing over and over and over again as a cookie cutter type model. And again, from the commercial perspective, we even look at the loans. The debt we get is very much commercial based, debt service or hard money, depending on the type of loan. So it is fundamentally a commercial mindset, I think, for a residential type of business or type of product.
Yeah, absolutely. So, I mean, you correct a lot of things here because I know I've got some flaws in my thinking. Probably more
I
than
don't
we
know
have
about that. You
time
might be
here.
smarter than me.
I don't know. Probably more than we have time here for you to solve, but maybe specifically about your business. You're in the distressed residential space. Deal flow, I would imagine, has become constrained, especially in the last 5 or so years. True?
Um,
False?
I, False, but only if you're better than the competition. And fortunately, there's a lot of competition, so it's easy to be better than a lot of them. And what I mean by that is you have to treat it like a business, really, where if you're going to do a volume, you have to treat the fundamental business is the lead generation and the negotiations on the front end to generate a top of the funnel volume sufficient enough to keep the business operational.
Right.
From a strictly sales perspective, if you're trading a new sales guy in roofing, we have a roofing company, for example, or loan officer back in the days where I started, like way back in 2005. You're always training the sales guy, like always be originating because you have to have the deal. I was like, oh, I had a great month, I could coast. Well, yeah, but you burn through that really quick.
Mhm.
And as you scale up in a business, it actually becomes easier after you hit probably a certain threshold of deal flow. Maybe cash flow management becomes more difficult, but in terms of like consistency of outcome, it becomes easier to actually keep a consistent pipeline of deals going because now there's so much stuff going on that, okay, if something goes south, it's not that big a deal because you got 10 more things that are going like not south. And that's how we've been able to overcome it. We focus on lead gen, we focus on negotiation on the acquisition side, And then everything else, I don't want to say it works itself out, because actually that's fundamentally my problem. I'm the problem solving department, so I actually don't generate the revenue. I make sure we cover our tail on the back end. But that's how we've been able to overcome that.
Got it. That's really interesting. What would you say when looking at the distressed seller types? Are there any themes to it that you're seeing right now?
More or less. So there's always a balancing act between motivation of the seller itself and the distressing factors that the seller is dealing with. So I like to call it a scale between motivation and urgency is what we have with the seller. So for example, for years during COVID, obviously we wouldn't have foreclosure because they just weren't happening really.
Right.
So a foreclosure, typical traditional foreclosure, is highly urgent because there's a foreclosure date where they're going to lose the property by, and after, I mean, you can kick the can down the road a couple times, but eventually it's going to happen.
Sure.
But that buyer profile might be very unmotivated because they tend to want to ignore their problems, just from what we've noticed from dealing with them. So then we have to negotiate one way with that type of seller, where I think I said buyer a second ago. Anyway, we have to negotiate one way with that type of seller where we stress the actual urgency of the situation. And then that elevates their motivation. So that's one type of seller profile. The other type of seller profile would be a more traditional distressed seller that just has a problem with a kind of junky house that they don't want to deal with. And it's very seldom that they don't know what the property's worth or anything like that. Often we'll tell them and we'll walk through the whole process and talk about the options. But maybe they have a hoarder house and they just have 3 feet of stuff in the house that they don't want to deal with. Maybe they inherited a house and they don't want to deal with the emotional trauma of dealing with the stuff.
Right.
We like to say when negotiating, money is always a motivating factor, but it's very seldom the fundamental motivating factor.
Mm.
As investors, we often project our expectations on the seller. So my expectation is I want to make a lot of money. Therefore, obviously, the seller, being a reasonable person, wants to make a lot of money on their house. That's not necessarily the case. They usually have an emotional trauma or an emotional issue with the house. So that's their primary motivating factor. So if we can figure out what that is and solve that problem, then we're not only in a better position to profit ourselves and our company, but we're actually in a better position to solve their problems. Not to monologue too long, but for example, we often beat our competition by 30 to, I think our record in the past 2 months is $60,000 below our competitors' offers by discussing this with the seller. And so you're not dealing with an uneducated seller. You're dealing with a seller that isn't served by a higher offer because they're not actually solving the fundamental problem. Whereas most people, 80% minus repairs, we're like, well, let's see what the seller actually wants and let's hit it from the other direction instead.
How do you do that? Like that sounds too good to be true. Like, how do you discover the motivations for selling and then offer them $50,000 less and get them to say, yeah, that sounds good?
Well, you need to make it good, don't you? So
Well, yes.
so take a traditional cold call lead, I suppose, which a lot of our competition does. And cold calling is our worst performing lead source in our company because we're not as good at the long-term follow-up as some of the guys are. But fundamentally, a lot of those types of lead origination mindsets deal with the property because they're burning through a lot of data, a lot of data points, a lot of lists or whatever. And then just in the nature of that lead, they're going to want to disqualify the urgency of the seller. Whereas if we have an inbound lead, if we have a PPC lead, a mailer lead, even a bandit sign lead, we've closed a couple of those. It's kind of weird, right? Then not only is the seller contacting us, but now we're not trying to disqualify the seller. We're trying to find out the actual underlying need that they contacted us. And we do that by having a long conversation with the seller about the actual situation that they're involved in. Again, it's going to depend a lot on the seller. So pre-foreclosure is going to be a lot more urgent and maybe even on our part, a little more aggressive negotiation technique than someone that has, a hoarder house that they don't want to deal with the trauma of the stuff. But we're going to find out what the trauma situation is, and then we're going to find out how we can solve that problem for the other person. We're not going to be qualifying the property to speak of in the initial conversations. So where our competition is going to say, well, tell me about the house. We don't care about the house. Like there's a dollar amount that the house makes sense for us. I think probably for like anything, like we'll do seller finance. We'll buy a house for $1, even if it's a complete whatever, and sell it to someone. So there's always a dollar amount that overcomes whatever problem there is on the house. And we're going to verify that once we actually go on an appointment or send pictures or whatever. So we always verify the house. That's not the problem. The problem is the seller,
Hmm.
because that's the person that we're trying to solve the problem for. So the better we're able to do that, the better we're able to have long conversations. Our average talk time for a qualified lead is probably 30 to 45 minutes, whereas our competition is probably 5 to 25 minutes. Um, and that sets us apart, maybe not in terms of volume, although we do a significant volume, but it sets us apart in terms of margin.
Yeah, that's and what are you obviously you're establishing rapport with the seller, things like that, but let's assume that you diagnose what the trauma is. I don't know, you could probably make something up, but we don't necessarily have to, but you diagnose what that is. Is your secret sauce in then crafting a solution to that trauma
Yes.
and then making them an offer kind of independent of that?
Yeah, absolutely. The offer isn't money. The offer is money's a component, but the offer is okay. You need $100,000. Well, what do you need the $100,000 for? Because I know I can only give you 50 grand or whatever it is.
Right.
Well, I need the $100,000 because I want it because of X, Y, and Z. Okay, well, if we can get you to X, Y, and Z, then is the offer going to be reasonable? Is that if I can get you where you need to be, is that going to be okay? If I can make it so I mean, pre-foreclosure is probably a good example. I need 100 grand because I need 100 grand. Okay, you're going to lose your house on Tuesday. You're screwed. Um, it's Friday. Like we can do this, but we're pretty much the only ones that can because just partially because you don't have time. So
Right.
now we have to say like, okay, if I can get you, this much, here's where you need to be. What else can I do to help alleviate your situation? Well, I'm going to need some time to move. Okay, no problem. We'll do a lease back. We'll do a hold back for the lease back. So we're covered. But now we're competing. Now we're beating the competition on the wholesale side, where the wholesalers, they're going to see a lease back as something that they're is cutting into their profit. For us, we close on 75% of our deals anyway. So it doesn't hurt us that much in terms of that. And we just factor in the carrying cost and the risk in like a decreased price or a lease back holdback. Oh, I don't want to do all the stuff in the house. You know what? No problem. You think you need 10 grand in dumpster fees? Just leave the stuff there. Don't worry about it. Automatically dropping our offer by 10 grand, right? Or whatever it is in their mind. So that's where we alleviate the emotional trauma for the sellers and other people can do that. It's just they're not as good at having the conversations about how to do that.
Yeah. How long has it taken you to craft that script or that kind of process? I mean,
Oh, it's a work in progress. I'm not the best acquisitions guy. My motivating factor of building this entire monstrosity that I have is I just don't like talking to sellers. They bum me out. Uh, they got a junky house. It smells funny. It's got stuff in it. They haven't fixed the roof for 30 years, and they know what they have. I don't want
right.
to talk to that person. I've talked to that person 100 times at the same exact house. It just happens to be in a different address. I'd rather hire someone, and that's where the kind of commercial mindset comes in terms of like building the business. I'd rather hire someone where that's their binary task, and that's what they do all day long, and they enjoy doing it. And they're paid well to do it. And honestly, they're better at me than doing it because I'm gonna be a nice guy. I know I can give you 5K more, and then you're gonna think that I'm an amazing person. Whereas if I send someone else out, oh, I got to check with my boss. Like there's that psychological hurdle that they have to overcome. They know what they can pay, but they're gonna know that now they have to come back and justify what they paid for it. And I'm gonna say, well, could you have gotten it cheaper? Well, no, absolutely not. I couldn't have gotten it cheaper. All right, awesome, good job. Could you have gotten it cheaper? Like, yeah, probably. Well, okay, you made 80 grand. You should have made 90. But, whatever the situation is.
Right. No, I like that. I like that a lot. That's it's always good finding people that are better at isn't that the name of the game as a
I
business
think so.
owner? Finding people, surround yourself with everyone who is better at everything than you is kind of one of my own mantras. Like, oh, I can only hire you if you're better at it than me because
Mhm.
I don't want to be the best at it.
No, that's a big misnomer in the entrepreneurial space, right? Everyone says like, "Oh, I'm never going to find someone to do XYZ as good as me." Like that's absolutely not true. Because first of all, you're probably not as good as you think you are. And second of all, if you're doing XYZ and ABC and a bunch of stuff in the middle too, you're not doing the critical stuff all the time as well as you can
Right.
at your max capacity because you're doing all this other stuff.
Right.
So if you hire someone that's honestly more intelligent and pay them better, they're going to have a holistic picture so they know where the thing fits in the entire holistic process of the business. But they're going to be sophisticated enough to know that their job is to do this one piece of the job to fit it into the bigger picture. And they're going to be able to do that piece of the job better than you 100% of the time.
Right. Yeah, specialization, man. That's imperative. I have a question, probably more from a personal standpoint, because I did a whole lot of house flipping all the way through and wholesaling through 2018. One thing I could never overcome in this space, tell me how you've done this, is that every property was completely different. And so even with project managers, even with the theoretically people on the bus that knew what they were doing, it somehow seemed like we could never get projects done as quickly or as well, or because there was never, I know you mentioned cookie cutter, and we got to that too, where it was like, hey, here's the finish schedule, here's the paint schedule, it's the same
Mhm.
blooming color every single time on every single wall, here's your trim type, here's your, but even with that, projects still vary. Oh, there's foundation issues here. Oh, there's that over there. I mean, it's a
Yeah.
constant problem solving thing, and each project has its own unique problems. How have you found a way to systemize that?
Uh, I mean, the short answer is I haven't. The longer answer is we try to make the product look relatively the same. We try to use consistent crews that we've used over and over and over again a lot of times. And in this market, actually, it's kind of annoying. Flips are probably our lowest margin product,
Hmm.
especially when you take into account turnover ratio, cash conversion cycle, my personal headache of going out and seeing these things. So that's the part that it's a little tougher to outsource, to be honest with you. It's easier to outsource a good sales guy, well, in office, but it's easier to train that and have that as a thing, as opposed to someone that has, getting into real estate in '06, that many years of construction experience where I can walk through a house in 5 minutes and know more about it than most people can in an hour.
Right.
I still walk construction sites.
Yeah. Yeah.
I do. Fortunately, we're only doing 6 rehabs now out of 30 deals, so about 20% of our deals are rehabs.
Hmm.
So it's not that overwhelming. And we try to have a good schedule of what needs to get done day one, and then trust the crews to do it, and then empower them to be able to do it. And then I touch base with them. I talk to some of our contractors twice a day, even now. Um, but that means that we made 35K yesterday, I think, on a wholesale that I don't know anything about.
Right.
So that's the part of the business that, yeah, I'm still very more active probably in that part than I really want to be. Um, but I'm not sure the best way to not be as active as I am in that.
Right. Yeah, that was a challenge that certainly I faced, and so you're doing better at it than I was, because I never
Mm,
was really doing it
I
at the
don't know
scale
about
that
that.
you guys are. But let me ask you this: so 6 of the 30, 6 of those are rehab. What are you doing with the other 24?
It depends. So that's where we're merging a exit strategy with the entrance strategy on the front end. Um, I don't know specifically because I don't even know all the addresses. But our exit strategies range from pure wholesale. So I mean that's awesome. Who doesn't want to make a bunch of money without any work?
Correct.
And it takes work, but that's a lot more systematized work where the acquisitions guys and the dispositions guys do the work. That's good. It's probably 20%, maybe 25%. I'm not sure.
Yep.
We wholetail some,
Hmm.
so in that we'll take it down. Like for a strictly perspective, we would generally call a wholesale anything that we actually close on. Um, with some things where there's a lease back or there's some stuff in it, it's probably technically mostly still a wholesale, even if we buy it for like a week. We've had wholesales that we've owned for maybe 7 to 10 days, and just either put it on the market or have it pre-sold. But for some reason, like a lease back or stuff in the house, we need to own it personally for a little while. And there's risk to that, obviously. There's transactional cost and there's transactional risk just with having the property. But we try to do that for the most part. We have a couple like that right now, I think. We do a lot of seller financing. So we do a lot of deals where we will buy a property for a good example really is buy a property for $100,000. Maybe its ARV is $200,000, but we're able to offer seller financing and sell it relatively as is for 140 to 150. And then we'll either term out the note or offer financing on a shorter term deal. And we attract a different probably buyer profile than a full like retail type buyer. So
Yeah.
those are the primary exit strategies we employ, I think.
How do you handle on the seller finance side of things? I mean, it takes a lot of money to hold those and then create those notes. And then, how do you keep that cash?
No, we just got rich guys that help us with that. Yeah.
Well,
We have some good note buyers. That's actually the next part of our commercial thing. We're in the process of building a fund to warehouse those notes because generally they're 20 or 30 year fully amortized, but the rates are really, really good. We're selling stuff with 12 to 13.5% interest rates right now with a 30-year product. So it's very appealing to a note buyer. It's very appealing to a cash flow owner that doesn't want the headaches of the actual ownership aspect of the property. They're very low default because we collect 10 to 20% down on all those deals. The buyers are generally, as well as you can, relatively well qualified for the properties. And they simply, I don't want to say they don't default, but they don't really default. So it's a good product. We're in the process of building a fund because obviously we're going to run out of money. Like even if we have $10 million, we're going to run out of money ourselves relatively quickly doing that.
sure.
So we're going to build a fund and stick a bunch of notes in there and cash flow for some investors, cash flow for us, and everyone makes more money. It's going to be exciting.
Absolutely. What are your forecasts on the distressed residential inventory? Do you see that going up? You see it going down? What are you forecasting?
I mean, so probably up a little bit. I think it's a little bit easier now than it was when there was a lot of the iBuyers just really soaking up all the inventory. I know they're still somewhat active, but they're not nearly as active as they were 2 years ago. Like any non-conventional lending, the iBuyers all operate on short-term interest rates to maximize their whatever. And as interest rates go up, they get pinched. We saw that obviously with the non-QM space with our takeout financing on rentals. You see it in the commercial space with apartments, that kind of thing. So I think the more our level of buyers are probably going to be at a competitive advantage over a lot of those people. We beat the iBuyers a lot just in terms of picking apart their offer and differentiating our process from their process. So I think on the retail side, I think we're going to continue to see low inventory partially because so many people are locked into a low interest rate loan. They're not going to want to quadruple their payment by doubling their house size. They're going to be like, you know what, I'm fine where I am. So I think that's going to artificially deflate inventory, and it's going to have an inflating aspect in terms of keeping the retail market up. And I think people that are needing to sell that have a junky house, I don't know many retail buyers that want to buy a house that needs 200K worth of work when they're going to have to come out of pocket 200K, even if they can conventionally finance the acquisition of that property. Right. So I think overall, I think we're in a good position to be in. We reevaluate probably every quarter in terms of the dispo strategies that are most profitable and that we have to do. And I don't know, we're having fun.
That's fantastic. TJ, thank you for taking the time to come on the show today. This has been a blast having you on. I've learned a ton from you. I love what you're doing and how you guys have done it, how you've learned how to scale this, the systems you've put in place, the teams you've put in place. I think it's really impressive because there's very few, I think, that have figured out. I know you said maybe you haven't figured it out, but you have a lot more than a lot of other people have there in the residential space. Taking that and scaling this business is really cool. I love what you're doing. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
I'm all over the place online. I'm super easy to find. Very creative too. So TJ Kosen on Facebook and Instagram, real easy. TJKosen.com. I mean, again, creative guy. And our what do you call it? Oh, our kind of company, like outward looking marketing page is REIAF, real estate investing. And I'm not really sure what AF stands for, but it sounded cool when I put it up there.
Fantastic. TJ Kosen, that's Kosen. For those of you who are listening and want to look TJ up, TJKosen.com. TJ, thanks again for coming on the show today. I do appreciate it.
Thanks so much, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.